I am going to go ahead and get started here with our next speaker. We've got Nathan Hasselhorst. He's a senior staff accountant with the Division of Examinations for the U.S. Securities and Exchange Commission in the Chicago Regional Office. He's got a bachelor's in finance from the University of Illinois, and he was in the position of Securities Compliance Examiner in the Office of Compliance Inspections and Examinations from 2000 to 2006. In both of these positions, he has conducted examinations of investment advisors and investment companies to ensure compliance with the federal securities laws and protects clients against financial harm. Nathan also holds a certified fraud examiner and chartered alternative investment analyst designation. So welcome today, Nathan. We're very glad to have you to give us some great information about how to protect ourselves with investing.
Great. All right. Well, thank you, Stephanie, for that introduction. Yeah, just so you know, just to familiarize yourself a little bit, the Securities and Exchange Commission, we think of ourselves as kind of like the Wall Street cops, so we monitor the stock exchanges, how people buy and sell stocks and bonds, and the people who make those kinds of recommendations for you. So I'm going to talk a little bit about that today with you. Just a couple little things, a little disclaimer: SEC disclaims responsibility for any private publication or statement of any SEC employee or commissioner. The presentation expresses the author's views and does not necessarily reflect those of the commission, commissioners, or other members of staff. That's basically saying is like I may throw in an opinion here or there. You can't hold the SEC to it. So, and as Stephanie kind of said, we'll be recording today, so just be aware of that. So what I really want to talk to you today about is really, you're hearing today all about your various financial or federal benefits that you have. I want to talk to you a little bit about what to look out for and what to think about when you're investing outside of those federal benefits and such. So kind of what keeps you awake at night as you're getting ready for retirement, some of the flyers that you're going to get in the mail, trying to convince you to invest in certain investment products. I want to talk to you a little about investment fees and how they can have a profound impact on your investment returns. I want to talk about a little the commonly pitched products, some of the things you're going to try to get sold to you. And then at the end, I'll just give you a few financial literacy resources that you can always look to if you have any questions. So just to kind of start with a little bit of basic financial planning, retirement planning advice. You just want to look at the big picture. I'm sure you've heard this talked about before, but you've got the three legs of your retirement stool. You got your federal pension, your FERS annuity, then you've got your Social Security, and then you've got your thrift savings plan. So I just want to talk to you a little bit about just some of the differences of those. I'm sure you probably heard a lot about Social Security this morning, but so I'll just hit the highlights a little bit. But your FERS annuity and your Social Security, what those are designed to is to provide you lifelong monthly income. They're both based upon years of service, years of income that you've made, and there's a certain calculation that spits out, and then you get a certain amount of money. And like I said, it's going to be lifelong money that you're going to get. And the other benefit of these is that they have cost of living increases, is that over time, every year, there's a little bit of a step up with inflation and such, so that your money, the value of your dollar, doesn't get eaten away by inflation. So those two are two of the big benefits that you get. And as I said, they're based, FERS is based off a high 3 salary. I think you'll be hearing more about that later today in a lot of the details. But really, the big thing you need to know about that is that the longer you work, the bigger your calculation. You get 1% for every year of service, and then you times that times your high salary. So if you've been working in the federal government for 30 years, you're going to get a 30% pension based upon your high 3 salary. One thing we want to note about this is that if you work at least 20 years for the federal government and you retire at age 62 or later, you actually get 1.1%. So it's just a little extra kicker. So if you work for 20 years at the federal government, you'd actually get 22%, of a pension instead of 20. If you work for 30 years, you get a 33% pension instead of 30. So those are the kind of things to be aware of if you're getting closer to retirement and, you're trying to make the numbers work. Just be aware of that you will get a little bigger pension if you retire a little bit later, not super early. And just the benefits of those is that, you just get a little extra kicker, I know I always throw this out there that, no one wants to think about working longer. Everyone kind of wants to retire at some point. But if you're getting close to retirement and you're not feeling super comfortable with what you've got saved and whatnot, you could actually work a little bit longer and your benefits do go up in that first annuity. For example, the example here, if you've got age 62 with 30 years of service, you'd get about a third of your average high three salary. If you work 5 more years, you actually get about a 40% pension. So that's 33 to 30 to a 40%, a decent little chunk to benefit you. And I think you already heard about this morning with the Social Security presentation, but same kind of concept. The later you go in waiting to claim your Social Security benefits, the value of that benefit goes up. You'll get a bigger amount every year, roughly about 8% increase every year that you delay. But just remember, again, I'll stress this again too, they probably told it in Social Security training, but your incentive, your Social Security benefit tops out at age 70. So if you're age 70, start claiming Social Security, because it's not going to get any better. So as I said, working a little bit longer, if you're not feeling comfortable about what you've got saved, you increase the amount of time you put into your first annuity. Also with TSP, I think you'll hear later today, is that after the age 50, you're actually able to make catch-up contributions where you can actually contribute up to like $7,000 more per year on top of the regular amount you can contribute to TSP to beef up that retirement. So you can always give a little bit more into your TSP. And as I said, postponing Social Security benefits is going to increase your benefit. So another thing we just want you to think about as you're getting close to retirement is that, you just don't magically say like, hey, I'm going to retire. Okay, let's go. You got to do a little bit of planning beforehand. And the big thing is kind of tracking, a few years of, for a few years, what your expenses are that you're going into retirement with. You want to know, are you still paying off your house? Are you still paying off any student loans or student loans for your kids possibly? You want to understand the amount of money that you're going to need to go into retirement, because you want to be able to craft a budget and you want to make sure that you've got enough retirement assets to pay for those things that you're doing, so but again, in planning for retirement, if you can get that mortgage paid off, great. If you can have, if you don't have any, student loan expenses, college education expenses, either for yourself or your children, that's great. That just, eases that burden in retirement. But then you also got to know, as we get older, we're going to have more medical costs. So you want to be aware of those medical costs as you're going into retirement, how those are probably may go up. But I know you just had a presentation for Medicare about, some of the benefits. So hopefully you're paying attention to that one too. So another thing you just want to do is you want to ballpark and get a good idea of what your life expectancy is. I know there's no definite end. No one knows when we're going to pass away, but you just want to be able to understand, how many years you need that money for. And one of the things you also want to just think about going into retirement is that there are risks of volatility in the stock market if you're doing an investment, and there's also inflation risk as we're feeling right now. So you just want to, with your investing, you just want to be aware of those issues and take that into account when you're making investment decisions. So if you do start investing, outside, or even in your TSP, you just want to kind of be aware of the stock market returns or bond returns that you'll get from different types of investments. What you see here is kind of a general chart of, investment returns over the last about almost 90, 100 years. And really, you can kind of see what this chart's trying to show you is that small cap stocks and large cap stocks traditionally have the, greatest potential for return over the long haul. There may be a few, obviously there's some bigger dips you can see there in like the 1960s and such, and then around 2008, you see big dips in the stock market there, and that's kind of highlights how a little more volatile the stock market can be. But over the long haul, that, the trend is up and to the right, and it's making those are making the most returns. If you were to just invest all of your TSP in the G fund in treasury bills, you can kind of see along the bottom that green line, it's barely, above inflation, which is the gray shaded area. So you're not actually getting too much investment returns if you were just invest everything in the G fund. So if you've got, the G fund is useful if you've got some short-term money that you don't, want to lose, at any time soon, or you don't need anytime soon. That has some safety and stability in there. But if you're investing for the long haul, you probably want to be investing a little bit more in stocks and bonds. And again, if you have a longer time horizon, so if you say you're in your 20s, 30s, early 40s or something, you've got 20 plus years until retirement, you can invest in a little bit more, volatile or riskier things like small caps and small cap stocks, or, large cap stocks. Because if you do suffer a loss, if there's a bad year, like there was last year, there was the stock market was down 50 or 30% at one point last year, you have time to make that back up. A great example of that is the 2008 financial crisis. Stock markets dropped like 40%, in over like a year or something like that, and hit a rock bottom in like March of 2009. But stock market turned back around, and by 2010, it had made all of that money up. And then the whole, decade of the teens, the stock market was just rocking and heading up, So I always say a little story about how my wife during that time was asking me, back in like February of 2009, she was getting a little worried about the stock market. And she said, should we be pulling our money out? And I said, not now. Now is probably the worst time to pull the money out of the stock market, because you would be buying high and selling low, which is the exact opposite of what you do. So if you've got a long time horizon for your money, you can stay invested and ride out those dips in the stock market. Conversely, though, if you're getting closer to retirement, say you're 55 or 60, and you're planning on retiring soon, or even if you're, once you're in retirement, you need to know that, you need to invest maybe a little bit more conservatively than you would in your 20s and 30s, because you need that money coming up. If I'm going to be retiring in 2 years and all of a sudden my stock portfolio takes a hit of 30%, well, that can drastically change, what your retirement is going to look like. So you want to have a good balance of investments in some stocks, but also some more conservative bond investments too, as you're getting closer and closer to retirement. This is just another quick chart just to kind of show you that, over the long haul, U.S. large cap stock performance is generally up. You do see some dips there, but if you kind of put your hand up and cover the top, cover the bottom, you see a lot on the top. If you cover the top, you see a few dips on the bottom. But this is just kind of getting across the point that for the most part, while there's some dips and there's volatility, as you can tell, generally the stock market over the long term is making positive results and can give you probably the best returns. Now I want to talk to you a little bit about some of the investment options that you're going to, be able to invest in outside of your TSP. They come with, they have this inverse relationship where if something is low risk, it's probably going to have a low return. So like cash is like that. You're a money market fund, your savings account at the bank, super safe. You're probably not going to lose any money in those kinds of investments. However, they're not going to give you very much of a return at all that you can plan for. On the other end, you've got stocks. While they are much more risky and they can, go up and down a bit more, over the long haul, as I was saying, they have higher returns. And bonds are a little bit more, so but essentially what you want to get out of this slide is higher risk, higher reward, lower risk, lower reward. So now some of you are wondering, as you maybe do some investing outside of your TSP and your benefits, what are some of the things you can invest in? Well, one of the most basic ones is a stock. Stock is also called an equity. And what that actually is a piece of ownership in a portion of ownership in a company. So if Microsoft issues 1 million shares and you own one share, you own 1/1,000,000th of Microsoft. And the benefits of these are that, the stocks typically have the greatest capital appreciation over time, the greatest potential for growth. And also equities, sometimes, not all stocks, but some stocks do pay dividends, which is kind of a little extra payment they pay out once a quarter, a couple times a year, where if you own a share, they're going to send 3 cents to everyone for every share that they own. So it's just a little extra payment that send out to you. So those are the benefits of equities. However, some of the risks are that share prices can decrease. Stocks are much more volatile and they can go up and down all over the place. You can lose money. Usually stocks, companies can go bankrupt. And usually when a company goes bankrupt, what happens is, they take all the money that company has and they pay out everyone that, the company owes money to. And people who own shares of stock, you're on the bottom. You're the last person on the list that gets paid with an equity share. All the bondholders get paid for you, all the, distributors, and, invoices and such, those all get paid out before you do it. So you may not get much back in a bankruptcy of a company if that happens, if you own equity. The other thing you also need to know is that your money is not federally insured in stocks. We all know about FDIC insurance if our bank goes under. There's no kind of insurance like that if just a stock market performs poorly and you lose your money in it. And now there are all different types of stocks that you can invest in. Every company's, in a different type of industry or they're in a different place in their kind of, company lifestyle. Growth stocks are these newer stocks that are up and comers. They usually have a lot more growth potential, but they are much more volatile. Income stocks are more your, stable stock, like a real estate income trust or a REIT. If they pay off a lot of income, they have big dividends. It's kind of how they give you returns. Value stocks are things like, your Procter and Gamble's and such, that make just everyday staples. They're those consistent, day in, day out, just making a decent return kind of company. So, and blue chip stocks are just what we call like large cap stocks. So there are different types of stocks that can meet different types of investment objectives. Now, another thing that you could possibly invest in is a bond. Now, a bond is a debt security. We all know how we borrow from a bank if we want to buy a house. We take out a mortgage and we borrow money from the bank. Well, a bond kind of works the other way, is where you actually loan money to a company. And then over time, they pay you out money. So kind of a basic way a bond works is that, say, you give Microsoft $10,000 in a 10-year bond. Okay, so what you send $10,000 to Microsoft, and then let's say it's a 5% return bond, then 5% every year you get a payout to you from Microsoft. So if that was a $10,000 bond, 5%, that's going to be $500 that Microsoft pays me every year, and that's my return. And then what happens then at the end of that 10 years, when that bond matures, you get all of that $10,000 back. And so your investment return, the money you make off of that, is all those interest payments you got over 10 years. Now, there are also risks in these too. Bonds can lose money depending on when you buy them, where you buy them. If you buy them initially, or if you buy them, somewhere in that 10-year frame in public markets, you can potentially lose money. They also suffer from credit risk. They lose value if the credit rating gets downgraded of the company and such. Interest rate risk and inflation risk. If interest rates go up or inflation goes up, that can kind of eat away at the value of those bond payments that you get. And they also have a call risk, is where they can actually pay you out early. Say Microsoft wants to pay you out. They call the bond and they can pay you out in year 3 or 4, give you your $10,000 back in year 3 or 4. And that can work to your disadvantage, because most likely the reason they want to pay you out early is because interest rates in the market are lower. So therefore, you would have to give up that 5% return you'd be getting from that bond, and you'd have to invest in the current market, which is not paying as good of interest rates. It might be only 2 or 3 or 4 or something like that. So call risk. So that's just another risk in a bond. One of the things I want you to impress upon you is that when you're investing for the long haul, some of us like to think we're stock market geniuses, and we got a feeling about how things go. And so you think, you can time the market, and you're going to pick those perfect times. But what a lot of studies have shown is that over time, actively trading in the market actually leads to underperformance, because most of the time investors are showing poor timing. They're following trends, or they're just overreacting to the good or bad news in the market. And so, you may not be able to hit that high, sell at that high point or buy at that perfect low point. And studies have just shown, like, if you're trying to, time that perfect spot, most people just don't do it well. And it probably would have been better if you just would have held it the whole time and just rode it up and down, and you would have been just fine. So it can actually affect your long-term investment returns when you're buying and selling a lot. All right. Now what I want to talk to you a little bit about is that as you're getting, close to retirement or in retirement, you're going to start to see a lot of flyers in the mail. They're going to try to convince you. You'll see a lot of them say, hey, come to this steak dinner, and listen to our investment presentation, it's tempting and everything, but it's kind of like a timeshare presentation. They're just trying to lure you in with a little, something that's worth $100 or $200 so they can sell you some type of product that's going to be thousands of dollars. So I just want to show you, get some examples of some of the things you might be getting in the mail that you should look out for. And also just want to talk to you about some of the types of investment professionals that are going to talk to you. So what this is just a little example of something one of us got one time. It's one of those envelopes with the perforations on the side. It looks all official. You got to tear off the sides and such. And it says on it, First Savings Plan Notice 2016, open immediately, So it looks a little official, like this thing might be coming from TSP. And then when we open it up, it's telling us about some TSP account value guarantee, available for all federal employees, 59 and a half and older or something, And what this is it's trying to get you to invest in some type of investment product. However, they're trying to give you the impression that this is something official from the TSP. But if you actually look down and read that fine print we highlighted in yellow down there at the bottom, it talks about how this is not affiliated with the TSP or any government agency. They're putting that little disclaimer in there for a little CYA, to cover their butts, in case anyone accuses them of fraud. But it's a little deceitful, the way they do things. And this is just kind of going over, a little bit about that. So, and another thing that was in this flyer too was it's the little tear-off postcard that you can send back and ask you to put your name in there and give them your name and number and everything. And it's also just a little deceitful. You can see down in the bottom left, they just put this number on the card, TSP-0116. It makes it look like some kind of like official form or something, but it's not. It's not that. It's just some made up number they just threw on there. But this is kind of some of the types of things you might see in a flyer that you should look out for. That is not legit at all. It's not affiliated with the TSP or your government benefits or anything like that. So these are really just sales tactics to try to get you to give them your name and number, so they can start to send you, more information and try to sell you investment products of some sort. The reason they do this is because actually at age 59 and a half, that's a nice magical number, is that that's the age which when you could start with pulling from your TSP or 401k plans and such, if you're retired. But also, if you're still working, you are allowed to make age-based in-service withdrawals of certain amounts of money. So, and these people know that. They know that you could pull out $100,000 or something and invest it in some investment product if you wanted to. And they know this, so that's why they market to people, at age 59, because they know you can get a hold of some of your retirement money at that point. Now, who are these people who are sending these things to you? The two big ones I want to talk to you about are broker dealers and investment advisors, but you're also going to have people such as insurance salesmen, financial planners, and you also have, a little less, common or general partners, finders, promoters who are trying to sell you some type of private investment, some private real estate deal, those kinds of things. So the two major ones you're going to come across are broker dealers and investment advisors. Broker dealers are regulated by the SEC, us. There's another group of my coworkers that do exams of them, but they're also regulated by the various states, and also what we call SROs, self-regulatory organizations. These are like, industry organizations that kind of try to police themselves. On the other side, you also might see investment advisors. That's actually who I examine. I go out there and I rummage around in the books and records and make sure they're not ripping you off and not lying to you about how they, do their business. As I said, they're regulated by us here at the SEC. If they're over a certain amount of assets they manage more than $100 million, they're regulated by the SEC. If they manage less than $100 million, they're usually managed by the various states. Now, the big difference between a broker-dealer and investment advisor is that a broker-dealer is compensated through commissions, and they're paid on a transactional basis. So they make a recommendation for you to buy a share, 100 shares of Microsoft or something. And then there's a small fee that you pay on top of the amount you pay for the shares, and that's his commission. Think of it like a real estate transaction commission, real estate commission or something like that. So, but the big thing to know is that they are paid when you buy and when you sell any kind of stock or bond. Recently, there was a change in some of the regulations around broker dealers, and the big change was called Regulation Best Interest, Reg BI. And now the big change in that is that when making a recommendation to an individual customer that involves a security, a broker must act in your best interest and cannot place their interest ahead of their own. So they have to act in your best interest. The investment that they're recommending needs to work out for you, and be the best thing that you can invest in. That's a good idea for you. This can mean also making sure that they sell you an investment product that maybe is if you have two similar investment products, the one that has cheaper investment costs and such may be more in your interest, so they should be recommending one to you. But this is the standard, the regulation best interest. One thing you should also know about this is that this regulation best interest standard doesn't just apply to recommending you buying and selling a stock or a bond. It also applies to recommending you to roll over your money from your TSP into, say, an IRA outside of the TSP. So, and this is one thing I actually want to impress upon you a lot, is that our investments in the TSP that we have, the expenses for them are super low. You'll hear later today, it's like 5 basis points or something, which is 0.05%, which is insanely cheap. And it's going to be very hard to find a cheaper investment product outside of your TSP. So be aware of that they gotta have a really good reason for you to roll your money over outside of TSP, given that this regulation best interest also applies to account rollovers and such. So if they're just trying to get you to invest in index funds, outside of the TSP, we've got those in our TSP already. We've got a large cap, the C fund, you got a small cap, index fund, the S fund. Those are great index fund options that we already have. And you're probably not going to find a better one outside. So be aware of this if they recommend you to roll your money out of your TSP. Now, that was talking about broker dealers who work on a transactional basis. Now I want to talk about investment advisors. These are who I regulate, who I do examinations of. Now, an investment advisor is a firm or individual that, for compensation, engages in the business of advising you as to the value of securities and the advisability of investing and purchasing those. What that means is that they don't work on more of a transactional basis. They more look at your whole investment portfolio, and they, make recommendations to you. And they are not paid transactionally. They're typically paid on a more of a periodic basis. Every quarter, you pay them a portion of the value of your account. Kind of a standard fee is like 1% or something. So if you have $100,000 portfolio, you may pay an advisor $1,000 a year to manage that portfolio for you. But the big difference is that they're not looking at your investment recommendations on a transactional basis. They're looking at it on an ongoing basis over time, and looking at the whole portfolio and how all of the investments work together, not just that one specific investment, if that's good for you. An investment advisor has a fiduciary duty to you to act in your best interest at all times. It's a little different than that regulation best interest I was talking about before with broker dealers. It's a little bit higher of a standard. So just be aware of that if you feel you want to hire an investment advisor over a broker dealer, just because the fiduciary standard is a little bit higher standard if there's ever issues of fraud or something. Just another thing I just wanted to throw out there and let you guys know about are robo advisors. These are investment advisors. However, the investment advisors aren't actually people. This is all a computer program. Once you input all of your your personal information, such as your age, your income, your health issues, this and that, and your goals and whatnot, it's just a computer program that spits out an investment formula to you. Now, the reason these become more popular is because since there's no real human, no day-to-day human interaction with a robo-advisor, they are a little cheaper. The investment costs are down. But again, that's the the converse of that is that they may have the lower fees. However, you don't get that level of human interaction as much. So if you want to just have someone to discuss it, they're not really going to do that. The robo-advisor spits out the investment portfolio for you and says, hey, why don't we do this? But like I said, they are a little cheaper if you want to be a little more cost conscious. Going back a little bit before when I talked about regulation best interest, one of the changes that made, and then it applies to both investment advisors and broker dealers, is that they all have to give you this new Form CRS, the Customer Relationship Summary. And basically, it's just a 2-page sheet, or it could be 4 for a duly registered advisor or broker dealer. But they just need to summarize for you in plain English the relationship that, how the relationship is going to work and the services that they provide to you. They need to outline all the fees and costs that you're going to pay. They need to outline any potential conflicts of interest, such as recommending their own in-house investment product or something like that. And they need to explain to you the legal standard of contract, that best interest versus fiduciary, legal standard. And they also have to disclose to you whether the firm or any of its professionals there have had any reportable legal or disciplinary history at all. That just means, they have to tell you if they've gotten in trouble with the SEC or the states or anyone like that. They've got to report that to you. So that's something you should be getting from any investment advisor or broker dealer that should help you understand your relationship a little more. So if you're wondering, like, well, I don't know the difference. How should I figure out what should I go with, a broker dealer or investment advisor? I don't know what I need. Just think about what, kind of level of service you want. If you're someone who likes to do it yourself, you like to do your own research, you like to follow the stock market and read the reports, and all you really need to do is have someone execute your trades, you can go to a simple Schwab or Fidelity or something, and they'll execute your trades for, $4.99 a trade, $7.99 a trade, whatever they're charging. But it's real bare bones. They don't really give you any advice. They're just helping you facilitate that transaction. So that's a very basic brokerage transaction. Maybe sometimes you actually want to bounce your investment ideas off of somebody. You could actually work with a rep at a broker dealer, and they can help you on a transaction by transaction basis. If occasionally you just want a second opinion on something, you could also go to a broker dealer for that. However, if you want someone to look at your portfolio, you don't want to do as much yourself because you just feel a little overwhelmed, you can hire an investment advisor on what we call a non-discretionary basis, where the advisor will look at your portfolio, make some recommendations, and they'll call you and say, hey, we want to do this. What do you think of this? I want to buy this and sell this. What do you think of this? And you say yes or no. We call that a non-discretionary investment advisor relationship. They're kind of checking with you, so they don't have discretion. The full on, discretionary investment management that an advisor could do is where you just basically, say to the advisor, here's my retirement account of $500,000, manage it, go for it. And then the advisor will do that. They have access to your account and they can manage it and do buys and sells day in and day out. And they're not going to call you every day and say, okay, I want to buy this, I want to sell this. They're not going to check with you. What they typically do though is they send you a statement once a quarter, once a month or so, once a quarter, just showing you the changes in the buys and sells of the account. But you give them discretion to manage it, as they should. And they'll just give you periodic updates about that. So just kind of think about that, about what level of service you actually want from, your investment professional. So Investment advisors and brokers, sometimes they also are financial planners. They may offer you financial planning. And now this can get beyond just your investment portfolio, where they can just look at retirement planning as a whole. So they'll take, retirement planning, they'll take into account your federal benefit, your health benefits, they'll look at your Social Security, any other outside pensions, and they'll kind of look more holistically outside of just that, portfolio, that account statement of your investments. They'll kind of look at your whole picture and give you a plan. They may recommend like, oh, maybe you need some life insurance over here. Oh, maybe we should, invest in some real estate over here or something like that. But they may give you a big financial plan. They could take into account, if you want to worry about saving for your kids' retirement, they can help you with your kids' college. They can help you with that too. Typically, the way these are done is that you just pay a flat one-time fee of $1,000, $2,000, $5,000, depending on the complexity of the financial plan that you need. But they'll lay out a variety of investment options to you. Maybe not necessarily securities based, but looking at your whole picture. So, if you're ever wondering about some of these investment professionals that are coming to you, you can look up your background information on all of them. There's on FINRA, you can just type into Google broker check, and you can look up there and see if they've had any issues, fines, complaints about them. Also, for investment advisors, you can go to the Investment Advisor Public Disclosure Database, the IAPD, and that gives you access to their Form ADVs, which has all types of information about investment advisors, their size, their history, their staff, what they invest in, all those kinds of things. Another thing too, you can look up on FINRA's website is the Professional Designations Database. Now we all know what a CPA is, right? Certified Public Accountant. But Stephanie rattled off a few designations for me: a Certified Fraud Examiner, Chartered Alternative Investment Analyst. I bet you guys have probably never heard of those before. If you're curious about some of these professional designations that they're spitting out to you, that they say they are, you can actually look them up in this database here and see if they're legit. Some are very legit, like a Chartered Financial Analyst, a CFA. That's super legit. There's years of tests and everything. Some designations don't take much at all. Fill out the form, answer a couple questions, and you can call yourself a TPA or whatever you want, made up one. So, so these professional designations, are all very different. Now, some questions you want to ask before you invest. Well, the big thing I want to say is that don't be afraid to ask financial professionals questions about what they're trying to sell you. Any professional who is on the up and up will not be afraid to answer questions. So don't be afraid to ask questions. There's all types of questions you can ask before you invest, all about the fees, the expenses, charges, commissions, and also just understanding the risks of these investments. What's their potential volatility, and also what's the liquidity. Liquidity means how easily you can get in and out of it. If you want to sell shortly after, how easy is it to sell that investment? 5 big questions are: is the seller licensed? You can look them up on BrokerCheck and see if they're licensed. Is the investment registered? If an investment is registered, that means they send disclosure documents to us here at the SEC, and we look over those. We don't approve investments, but we do just make sure that they're telling you all the information that you need to know. You can ask the investment professional, what are the risks? How do the risks compare with the rewards? If it's something's highly risky, but it offers low returns, well, that's not that great. If high risk is going to demand some potential higher returns too. So you want to know the comparison. You want to be able to compare those. And also just a big question is, do you understand the investment? Is this investment professional, are they trying to get you to invest in some crazy crypto thing that you don't understand and it boggles your mind? And, if you don't understand an investment, I wouldn't invest in it either, So I'm not saying you got to understand how like Microsoft, does the coding for Windows or anything like that, but we all kind of know what Microsoft does essentially. So the other big question, another good question you want to be able to ask is, where can you turn to for help? If you've got questions about your investment, and your investment professional can't answer it, who can you go to ask a question? Sometimes there's, a dial-in customer service number at the investment or the company you're investing in. You can ask questions there, but just know who you can turn to for help if you're not getting the answers that you want. Next thing I want to talk about is fees. You always want to know what your investment's going to cost, and I want to show you why it matters. All investments have fees. They're all going to have some, and they matter because while they may seem small, these can impact your returns greatly. Most types of investment accounts have some type of commissions charged. Whenever you buy and sell a stock or bond, you're going to pay some type of fee, a little transaction fee. It could be $1, it could be $5, it could be $10 every time you trade, but you want to be aware of those. You want to be aware of what the annual fee is charged by an investment advisor. Some might have a minimum charge that they're going to charge you no matter what. Mutual funds, which I haven't talked about yet, but that's a common investment product. They all sometimes have upfront loans that you pay before you get into it. And mutual funds all have ongoing expenses that are charged to them over time. And again, as I was talking before about liquidity and how do I get out of an investment, you want to know if there's any potential surrender charges if you sell your investment early. Things like annuities are very commonly have surrender charges if you sell them within the first 5, 6, 7 years of investing in them. You'll get hit with a little charge if you pull out of that investment too early. Now, the next page, I want to show you a chart. It just shows you the effect of the varying investment fees can have on your account. So the next chart is going to show if you had $100,000 and you invested it for 20 years and you made a 4% annual return. This is going to show you the impact of those fees if you have a 0.25% charge, a 0.5% charge, or a 1% charge. Now, as you can see, the bottom line is if you invested in a product and had a 1% fee, over 20 years, that $100,000 becomes $180,000. If you were a little more cost conscious, say you invested in something that had a 0.5% fee, well, that's that red line. That's almost a $20,000 difference that you can see on that chart from just saving, being a little more cost conscious about what you're investing in. And then if you really are even much more cost conscious, you invest in something that only has a 0.25% fee, that's 30% or $30,000 more than that 1% fee investment. So you can see here how investment fees can, really decrease the value of your account over time. If you're investing in something that's a little too expensive. Now, one thing I want to highlight here real quick is that you can see even the best one here is 0.25% annual fees. Remember, your TSP is sitting on like 0.05, 0.06, percent fees. TSP is insanely cheap. I don't think you're going to find much cheaper of an investment out there. It's going to be very, very hard. So be aware of that as you're thinking about investing outside of your TSP. We do have some great investment options in our TSP. And again, fees reduce your investment. Just be aware of that. So 5 more questions you could ask about fees. What's the total fees to purchase, maintain, and sell this investment? What does it cost me to get in? What does it cost while I own it? And what does it cost on the back end if I want to get out of it? So are there ways to reduce or avoid these fees? Could I invest if I have 2 blue chip stock funds, but this one charges, like I was saying before, 0.5% versus 1%? Well, I want to invest in the one, the similar one that, give me the kind of same thing for a cheaper price. One thing you want to know is how much does this investment have to increase in value before I break even? One of the things I talked about was investment loads, sales loads on a mutual fund. What a sales load is say it's a 3% sales load. So that means if I put $100 into some mutual fund and it's got a 3% sales load, that means 3% comes off the top to pay this investment professional, and only at $97 actually goes into the mutual fund. So what that means is you've got to make over a 3% return just to break even, after that fee is taken out, that selling fee is. So you just want to be aware of how much return you've got to make to actually break even, so, and just, what are the ongoing fees to maintain my account? A lot of accounts may have, account maintenance fees and such if your account is a smaller size and such. So you just want to know what some of these other little ticky-tacky, fees that are charged. So what are some, I think I've only got 5 minutes left, so I'm going to speed through the last slide real quick, but you just want to be aware of what's out there. As I was talking about a mutual fund is a big pool of money that's made up of a lot of stocks, bonds, and whatever. And it's not just you, it's hundreds, thousands, tens of thousands of people all putting their money together into this one big fund. And you just get some economies of scale out of that. You can spread your money out a lot more than you could if you just put in your $1,000. Well, now you've got $100 million from all these people. You can buy a lot more different things with it. So that's kind of how a mutual fund works. It's a big pool of money. The advantages of a mutual fund is that they're professionally managed. Some investment advisor who supposedly knows what they're doing, but it's their job to monitor this portfolio much more than you can. You've got a job to do and you're working. So, you don't know it as much. So there's someone professional doing it. And as I was saying, diversification, you can spread your money over a lot more investments when you've got a lot more money. So, and it makes it affordable. You just put in as much as you can afford to put in. You don't, not a lot, many of them don't have, large investment minimums or anything like that. So, and the other thing is liquidity. Mutual funds, you can sell every day, Monday through Friday. You can sell mutual fund shares every day. So you can get out of them very easily. So if you want to know any details about a mutual fund, you can look at their registration statement that they file with the SEC. We call that a prospectus. It's got all the ins and outs of the mutual fund, investment goals and objectives, strategies, how it's going to invest to try to achieve those goals. What are the risks of those investments? And the big thing is, what are all the fees and expenses of this investment? It'll also give you a little bit about the past performance, how it's done in the past. They'll usually compare it to some stock market index. How do you redeem those shares? And then they'll tell you about the investment advisor, that professional manager that's managing the portfolio. And as I was talking before, mutual fund fees, they have lots of different sales loads, redemption fees, exchange fees. These are all outlined in the prospectus. You can get a lot of details about those. So if you're looking for something a little more basic of a mutual fund, they have what they're called index funds. An index, we've all heard of like the Dow Jones Industrial Composite or like the S&P 500. That an index is just a set portfolio, set group of companies, and then it just follows them along the line. And they're, companies are not popping in and out of these indexes every day. They change up once or twice a year or something. So all an index fund does is just copy this index. So if you just listen in at the end of the news at the end of the day and you hear what the S&P 500 did that day, your S&P 500 index fund will have done pretty much the exact same thing. The advantage of an index fund is that because of this passive management, they're not buying and selling every day. That means they charge you less of a fee because the investment manager managing it doesn't have as much to do. They really just kind of keep an eye on it every day, but they're not buying and selling, and they only change whenever the index actually changes. So that just means that the investment advisor is going to charge a lower fee. It also means that there's less trading going on. So there's not going to be as much transaction expenses within this mutual fund. So it's just going to lower the cost. So index funds are a good way to just lower your costs. All the TSP funds, those are all index funds. And the other thing about this too, with the less trading, I was talking earlier about trying to time the market. You don't really do that with an index fund. You just kind of write it out as it goes. So an ETF is very similar to a mutual fund. The only thing is that you can actually buy these every second of when the market's open during the day because they're traded on an exchange. Mutual funds you can buy in and out once per day. ETFs are traded on the stock exchange and you can buy them in and out 100 times a day if you want to. So if you're curious about mutual funds, you can actually go to FINRA's website. They have a fund analyzer. You can punch in the ticker or the names, and they can actually give you a little chart and you can compare and contrast some of the fees and whatnot between them. A variable annuity, my quick opinion right here is variable annuities are insurance contracts you have with an insurance company where you put a lot of money into them, either at one time or payments over time. And then at some date in the future, they're going to pay you back a lot of that money you got, promising you some kind of investment returns. I will say variable annuities have lots of costs involved in them. They try to sell you riders and everything. There's lots of commissions up front. variable annuities are expensive. So kind of the theme of my whole presentation here is watch out for, high fees and how they can affect your returns. Variable annuities can affect your returns a lot. So I'll flip through these real quick. Digital assets, crypto's complex. I don't even understand it. It's highly volatile. Don't invest anything in crypto that you can't afford to lose tomorrow, because you never know. I think like 95% of crypto is worthless. We all know about, all the big ones and such, but, a lot of them have just gone worthless and they're highly risky. Be wary of those. So, and then so the last, I can see Stephanie looking at me, trying to get me to finish up. Yes. Just here's we have a few resources on the SEC's website. If you're curious about a specific topic, you can go to sec.gov/investor/alerts. And we have all sorts of investor alerts about various topics. If you're curious about anything, look at those. We also have, investor.gov is also a great website where you can get lots of information about various investment topics if you got just curious how certain things work and such. Here we go, investor.gov. And with that, I am done. I think I got in at 50 minutes. Excellent.
All right, great. Thank you so much. I know you have lots of information. It's really helpful to know. We do have questions in our chat, so I will send you over those if you wouldn't mind just writing a written response to a few of them, so that we can move on to our next presentation, if that is good with you.
That sounds good.
All right. Thank you so much, Nathan. We really appreciate it. All right.